Hello everyone, hope you guys are doing well. Today's video is about a question from May-June 2023 and the paper is basically paper 2 variant 1, and this question is a mix of three topics. So there's one topic called provision for doubtful debts, there's one called topic that is depreciation and disposals, and the third one is capital and revenue expenditure in this particular question. So the question says here, Stella is a sole trader who sells on credit. She maintains a provision for doubtful debts at 4% of trade receivables. Stella's trade receivables were at 31st December 2021. That means those trade receivables will be the opening trade receivables of 2022. So at 1st January 2022, trade receivables will be 75,000. And similarly, at 31st December 2022, trade receivables are 77,000. So here they're expecting you to make a provision for doubtful debts account for the year 2022. Then they're saying balance the account at 31st December 2022 and bring down the balance at 1st January 2023. What you need here is that you need the opening balance for provision for doubtful debts, you need the closing balance for provision for doubtful debts, and you need to transfer some amount to the income statement depending if the provision has increased or decreased. So in this case, provision has increased because I know this because my trade receivables have increased. So when I take out 4% of 75,000, so this will be the balance brought down of this account. That will be 3,000. So 3,000 was my provision for doubtful debts at the end of year 2021, which will be the opening balance of this T account. Start this T account with this opening balance 1st January 2022. I write here balance brought down. I write here 3,000. And then what I need to do is that at the end of 31st, basically at the end of 2022, at 31st December 2022, I'll again actually calculate provision, and that'll be 3080 now. So that means my provision has increased. When provision increases, it goes to the income statement's expense section and it becomes an expense basically. So you write this income statement here. So what I found out at 31st December 2022 was 4% of 77,000, which is 3080. So now my provision is increasing, and when provision increases, it goes to the income statement's expenses section. So I write here on the credit side of this account $80 from the provision has increased by $80. So previously it was 3,000, now it is 3080. What happens is that this provision for doubtful debts account is basically a contra asset account. Contra means opposite, and contra assets basically increase on the credit side, decrease on the debit side, and they have their balance brought down on the credit side of. So you write $80 income statement and you write here 31st December 2022. This income statement will be made on 31st December 2022, and in the income statement, in the expense section, we'll write $80. So here what the double entry is, income statement debit, provision for doubtful debts credit. That is what double entry is being made here when we are transferring the amount to the income statement, that is $80. Then we get a balance carried down here. So 3,000 plus 80 is 3080, which we had calculated 4% of 77,000, and this will also be 31st December 2022, and this account will close, like the total of this account will be 3080 on both sides, and this balance carried down will become my balance brought down. This will be 1st January 2023. Okay, in the next part they are saying state 2 reasons why Stella maintains a provision for doubtful debts. So provision for doubtful debts is an estimation of those trade receivables who might not pay us in future. So Stella is basically applying the concept of prudence. So when I write here applying the concept of prudence. So the prudence concept says that in accounting, you must not overstate your assets and you must not overstate your profits. So by making a provision for doubtful debts, you will create an expense of those trade receivables who might not pay us in future. In that way, we wouldn't overstate our profits because there's an additional expense that we are creating. And in the statement of financial position, we will subtract the provision amount from the trade receivables. So we'll not even overstate our assets in that case. So we are applying the concept of prudence. Also, we are accounting for the losses that might occur in future. So Stella is accounting for the losses that might occur in future. They are asking you for 2 reasons. So you can say For the other reason, she's also applying the concept of accruals and matching. So, whenever they apply the concept of accruals and matching, the concept of accruals and matching says that revenues of one period must be matched against the costs of the same period. So, in one particular year's sales, if Stala predicts that from a particular year, let's say 2022, from that year's sales, there'll be some people who might not pay. So she will show the expense in the same year by creating a provision for doubtful debts. She'll also apply the concept of accruals and matching here. Okay, in the next part, they're saying Stala charges depreciation at 25% per annum using the reducing balance method. She charges the full year's depreciation in the year a vehicle is purchased and none in the year when it is sold. So no depreciation in the year of disposal, but full year's depreciation in the year of purchase. They're saying on 31st December 2022, Stala sold a motor vehicle for 9,500. So this is the selling price of the motor vehicle. The vehicle had a cost of 16,000, so that's the cost price on 1st September 2020. So that means we have purchased it in 2020. So we have a normal accounting year here, so that is January to December. So the first year for this motor vehicle would be 2020. So January 2020 to December 2020. This is my first year for this motor vehicle. The second year would be January 2021 to December 2021. So that will be the second year for this motor vehicle. And the third year will be January 2022 to December 2022. So that in 2022, we won't depreciate this because that's the year of sale for this motor vehicle. So what we need to do is that we need to calculate 2 years depreciation. Now, when you are calculating the profit or loss and disposal, what you need to do is that you need to calculate the net book value. And to calculate net book value, you need to know the accumulated depreciation of this asset which you are disposing of. So net book value formula is cost minus accumulated depreciation. Accumulated depreciation is the total depreciation that you have charged for the asset. So it means that if you've used a motor vehicle for however many years, that doesn't matter. Total depreciation means that whatever total depreciation we have charged in all the years that we have used this motor vehicle. So this motor vehicle we've used for 2 years, and in 2022 we are selling it. So that means 2 years depreciation you have charged on that. So accumulated depreciation will be 2 years depreciation. So when I calculate accumulated depreciation, I'll basically apply this formula. So cost was 16,000. The formula for RBM is so depreciation for 2020 will be 16,000 minus 0. Accumulated depreciation in the first year is 0. So the RBM formula is cost minus accumulated depreciation multiplied by percentage. So 25% you multiply it by 25% because depreciation here is 25%. Now you get here 4,000. 4,000 is your depreciation for first year, that is 2020. Depreciation for second year, that is 2021. You'll do 16,000 minus 4,000 multiplied by 25%, and this will come out to be 3,000. And then the total value of depreciation here will be 7,000. That is 4,000 plus 3,000. And this is the total depreciation. Now when I calculate net book value, it's pretty easy. Cost is 16,000. We had purchased this motor vehicle for 16,000 and we have depreciated it by 7,000 in total. So the net book value here will be 9,000. So 9,000, you have to now compare the net book value with selling price. So your net book value is your estimation of the value that you'll receive from the sale of asset, but the market value can be different. So if your net book value is basically less than your selling price, which is in this case, it's going to be a profit. So net book value in this case is 9,000. However, selling price is 9,500. So that means we expected that we'll get 9,000, but we got more than 9,000. That is 9,500. So the profit on disposal here will be 500, the difference of net book value and selling price. So that's how you calculate profit or loss on disposal. So the other case would be that if your net book value is more and your selling price is less, that is the case of loss. Okay, so what you need to do is that you to calculate profit or loss on disposal, you need to know the net book value of that asset which you have disposed of. Once you know the net book value, compare it with the selling price. Okay, in the next part they are saying make motor vehicles account for Stala in the ledger of Stala. and this will be for the year 2022. So they've given you cost of motor vehicles at the start of the year, but from this you have sold one motor vehicle during the year. That was the cost of it was 16,000. So you guys must know that this is a cost account only. So all values in the motor vehicles account, or in the fixtures account, or in the computer equipment account, whatever the non-current asset is, all values in this account is going to be cost, only cost. So when you start the year, so that will be 1st January 2022. I write here balance brought down. I write here 48,000. This was my cost of motor vehicles at the start of the year. From these, I have sold one motor vehicle which I bought in September 2020. But the date of sale for this motor vehicle is 31st December 2022. So I must write the date of sale here, and I'll write here disposal. And the cost of that asset which I have disposed of is 16,000. So I write here 16,000. Then I get a balance carried down. So there's no other motor vehicle that I have purchased. So I don't need to worry about that. I just record disposal here, and then I get a balance carried down here, 31st December 2022. So 48,000 minus 16,000 will give me 32,000. So when I total this account, I total this at 48,000 on both sides. This balance carried down will become balance brought down. 1st January 2023. This is my motor vehicles account. So please note that this disposal value that you are going to write, it's only going to be the original cost of that asset which you have disposed of. So don't write the selling price, please. Many students make that mistake. Okay. So in the next part, they're saying make the provision for doubtful debts account. In the next part, they're saying make the provision for depreciation on motor vehicles account for the year ended 31st December 2022. They're saying balance the account at 31st December 2022 and bring down the balance at 1st January 2023. So the total depreciation at the start of the year, provision for depreciation of motor vehicles account, the balance on it was 21,000. So I write here balance brought down. I write here 21,000, and this will be 1st January 2022. And then I need to calculate the value of income statement for the current year. But before that, I know the total disposal value. So the accumulated depreciation of that asset which I have disposed of, I need to remove the depreciation. This is a contra asset account. It increases on the credit side, decreases on the debit side. Whenever I'm removing some value from this account, I need to record this on the debit side of this account, because I'm removing that value. And whatever asset that I have disposed of, I don't need to keep its depreciation in my accounting records. So I write here 31st December, that is my date of disposal 2022. Disposal value will be 7,000, which I had calculated in part B to actually calculate the profit or loss on disposal. This will be 7,000, and then I need to calculate income statement value. So for income statement value, you guys know this, that the total cost of all the non-current assets like the motor vehicles at the start of the year was 48,000, and the total depreciation of all the non-current assets, that is motor vehicles, at the start of the year was 21,000. So both these values include the values for that asset which I have disposed of. So 48,000 includes 16,000, and the policy year is full year's depreciation in the year of purchase, none in the year of disposal. So I don't need to depreciate that asset which I have disposed of. So I need to remove 16,000 from 48,000. So I will remove this, and I need to remove 7,000 from 21,000, because the depreciation also I need to remove, because I'm going to apply the formula for RBM. RBM formula says cost minus accumulated depreciation multiplied by percentage. So the cost of remaining assets would be 32,000, and the accumulated depreciation of remaining assets would be 14,000. So when I subtract both of these, so 32,000 minus 14,000 multiplied by 25% would give me 4,500. This is my income statement value for provision for depreciation account. I write here 4,500. This will be 31st December 2022. Then I get a balance carried down here. So 21,000 plus 4,500 minus 7,000 will give me 18,500. This is the total depreciation at the end of the year. That is 18,500. The date will be 31st December 2022. And I will balance this account at 25,500 will be the total of this account on both sides, 25,500, and this balance carried down will become your balance brought down, 18,500, and this will be 1st January 2023. So that's it for these both T accounts. So the last part of this question says Tala has an extension to her retail premises built during 2023. The extension will be used as an office. Basically, this question is based on capital and revenue expenditure, and I've already made a video on that. You should know what capital expenditure and what revenue expenditure is in order to attempt this kind of a question. Here they are saying place a tick in the correct box below to indicate whether each cost is capital expenditure or revenue expenditure. So what you guys need to know is that capital expenditure is always one-off and revenue expenditure is always recurring. So you need to keep incurring revenue expenditure on a yearly basis or on a monthly basis. So legal fees for obtaining permission to build the extension, you will take it only once, and then once the extension is built, you're not going to take the permission again and again. So that is capital expenditure. Building cost for the extension, so when you make the extension, you make it once, and building it is a cost, so that is a one-off cost, so that will be capital expenditure. Insurance for the office, when you get your office insured, you'll pay the insurance premium every year, so that should go as a revenue expenditure. Painting the office extension, when you build the extension for the first time and when you paint it, that's when you make the office extension once, and then when you get it painted, the painting cost is part of the cost of building the extension, so that'll be a capital expenditure. Office calendar for 2023 will be a revenue expenditure, because in 2024 you'll get another calendar for the office. Purchase of office equipment is the purchase of non-current asset. Purchase of non-current asset is always capital expenditure. So purchase of non-current asset, also to make it functional, you need to get it installed. So if you get the office equipment installed, that's a one-off cost again. So that is also capital expenditure. Stationery for the office, you will keep on buying stationery for the office because it's also a recurring expense. So you should record that as a revenue expenditure. So that's it for this particular question. Thank you so much for watching.